Good morning, everyone. Thank you for joining us. My name is Jill Halford, and I'm the head of charities at BDO. I hope everyone is keeping well in these difficult times that we find ourselves in. This is our third charity webinar that we've held during lockdown, and we've tried to develop a series of webinars to help our charity clients during this difficult time. If you did miss the first two, then do let us know. We can always send the recordings through. And we can send you a link so you can catch up on those. So what's our topic for today? Well, lots of people tell me that charities don't pay tax, if only. As a sector, we've got many tax benefits, of course. However, we've also got many challenges as well. Being a trustee myself, I know the complexities of partial exemption, changes to operations and how that can affect things, trying to maximise a gift aid, for example. And over the coming months, some of the conversations I've been having with charities around forecasting whether their trading subsidiaries have sufficient cash within the business model to pay the gift aid up to the parent. Obviously, there are a number of ongoing VAT cases as well, which we're going to cover some of later today. So we often deal with charities who are struggling to keep on top of those rules, or in some cases have fallen foul of some of those rules. So what we thought would be helpful today is to just go through a number of those topics and try and prevent you falling foul of some of those and having the knowledge to be able to ask some of those key questions for what your charity is doing. Now, obviously, we're in a difficult time at the moment. COVID is putting a lot of pressure on funding, and you may have seen there was a recent study came out to say that the sector is estimating 24% fall in income over the next 12 months. So with that background, we really don't want to be in a position to be suffering any further losses to HMRC as well. So we thought this was an opportune moment to highlight some of the questions you should be asking to make sure that you stay on top of the rules and regulations. And today I'm joined by some fabulous colleagues who will guide you through some of those difficult challenges. So we've got you for an hour, and our plan is that we were going to kick off with our Head of Not-for-Profit Tax, Paul Knight. Paul's going to give us an overview of the economic uncertainty on corporation tax. Paul will then hand over to Glyn. Glyn's our VAT not-for-profit specialist with a team supporting him as well, and he's going to take us through some of the latest government announcements as well as some of the charity case studies that we've seen more recently. Glyn will then hand over to Caroline, and Caroline's a deep expert in employment tax, and there's a lot going on in that arena at the moment. So we've got quite a big session from Caroline, and then we will reserve some time towards the end for Q&A. So please do keep your questions coming all the way through, and then we'll pose those to the panel towards the end. So without further ado, I will hand over to Paul.
Brilliant, thank you very much, Jill. So we are going to talk to 3 points around managing corporation tax in the context of the economic challenges that the coronavirus has given rise to. So we'll kick off with an example of a situation which is relatively common. What this slide is showing is the fact pattern that causes a bit of a conundrum as to how to manage your corporation tax in trading subsidiaries. So the example here is you have a March year end and the subsidiary makes a profit of £100, like it has done for many years, and the standard procedure for managing corporation tax with trading subsidiaries is, of course, to make a donation of those profits to the parent charity. However, in my example, some challenge arises because since the March 20 year end, this subsidiary has started to accrue losses. So my first example here, you've made a £350 loss in the period up to the date at which the subsidiary is able to make the donation to mitigate the tax in the previous period. So most of these subsidiaries will be making their donation within 9 months of the year end. So in this fact pattern, we've made a loss. We've made a sufficient loss that we've actually dropped into a negative reserves position by the time of the donation deadline. This causes us a problem because in company law terms, that donation is a distribution of profits, and distributions can only be paid from a position of positive reserves. So in this fact pattern, the trading subsidiary would be unable to make the donation at that deadline. This wouldn't give rise in this particular circumstance to an actual tax cost in normal circumstances if the entity carried on making losses up to the end of that year, because there are rules that allow us to carry that loss back into the previous period and eliminate the profit from the March 20 year end. So no actual tax costs, but you may be in a position where you had to pay some tax and then wait until you can file a claim to carry a loss back. So you'd need to be able to manage that. Going forward, your tax and accounting position should be harmonised, even with making the carryback claim, but you should be aware that in these circumstances you may need to be making an actual tax payment. The second example, if we move on to the next one, this is slightly different, and you would have a different question over what you should do. So in my example here, same with the March 20 year end, and then up until the point where you're in a position to make that donation, you're breaking even. On the face of it, certainly from a tax only perspective, it would make perfect sense to make your donation at that deadline date. You've got the £100 of distributable reserves to do it, and so you would normally expect to make that payment. However, if you are forecasting a loss to the end of the 2021 period, there's another question mark that arises here. Even if you're in a technical position to make that payment, as to whether the directors of the subsidiary are operating within their duties to make a payment when they know that they are going to go on to make a loss, or are fairly certain that they're going to do so. So even where the numbers on a page look like it supports a donation, there's still some thinking to be done about managing a subsidiary in a potential loss position as to whether or not that is the correct and appropriate thing to do. And the third example illustrating the same sort of problem is perhaps the worst case, where you have a situation where you still have the same period up to the same situation up to the March 20 period. We have the loss accruing up until the donation deadline, but then actually have a significant turnaround in fortunes running up to the end of the accounting year. So in that circumstance, at the date at which you are able to make your donation, sorry, the deadline for making your donation, you're not able to do so because you have negative reserves. But by the time you complete that year, you actually don't have a loss overall to mitigate the tax from the March 20 period. So in this circumstance, you would be in a position where you wouldn't be able to use your normal corporate gift aid, you wouldn't be able to rely on carrying back a loss, and you would have an actual tax cost. So again, there's just 3 examples of different fact patterns there. All of them illustrate the sensitivities about managing your donation position, your loss relief position, where you have moved into losses since the last accounting period. I think the key messaging on this is to think about it as soon as possible. It's important that when you are looking at your trading subsidiaries, you start to think about what levers you've got available around gift aiding, around carrying losses back, and in more advanced groups around offsetting losses between group companies and just preempting where you think you're going to end up. And it may be bringing forward some donations is an appropriate option. Interlinked with that, failing trading subsidiaries, the temptation is often to put some money from the charity into the subsidiary to support its activities going forward. And of course, that can be entirely appropriate where the underlying business of the subsidiary remains robust. But clearly, where the subsidiary is making a loss now and may do for some period of time, great care needs to be used in allowing the charity to fund the subsidiary to ride out a period of difficulty. The main bit of corporation tax law that comes into play here is around approved charitable investments. A charity funding a subsidiary needs to do so for the benefit of the charity. And that will generally, for most trading subsidiary scenarios, mean that there is a financial advantage to the charity of advancing any form of equity or lending. The approved charitable investment rules are contemporaneous. So if you have lent to a subsidiary or invested in it in equity in the past, and it's now starting to struggle, the fact that the subsidiary is struggling now does not prejudice the original approved charitable investment claim, but you would need to be careful about advancing new amounts of debt, even under existing revolving facilities, or investing in more equity. The area that very often can catch organisations out is where a management charge, where the subsidiary pays the charity to share some of the costs in order to allow it to run. If you allow those charges to build up beyond normal commercial terms of repayment, those too will be treated as approved charitable investments, and the same tax law will apply to them. That's a bit of a one to be careful about, because it's not as obvious sometimes as advancing a new loan might be within the organisation. So care to be taken on allowing management charges to build up. For completeness, I've put there transfer pricing, corporate interest restriction. Those are another two areas that will apply on intercompany investing and lending, and those will often, or those may also be in sharp focus in the current circumstances. And then the last point I wanted to make on the corporation tax section is actually not technically corporation tax. It's to do with gift aid, individual giving gift aid. So for those that are applying the gift aid scheme to top up donations with the income tax of the donor. And this was just a flag that there's a lot of momentum at the moment within the sector across lobbying groups and large fundraising charity, well, large and small, a wide cross-section of organisations who are lobbying very hard to try and encourage the government to introduce an emergency relief package to top up gift aid, effectively increasing the rate as if the basic rate of tax were at 25% instead of 20%, which would mean charities could be receiving £33 for every £100 donated, as opposed to the £25 under the scheme as it is now. That is an ongoing position. If you're interested, then we can talk more about that. And it was really just a flag that is being pushed quite hard, and you may want to have a look at that and perhaps even put your own comments forward to support that if you think it would be a useful thing for the sector. I haven't had any latest updates indicating that that's progressed beyond discussion stage at the moment, but there we go, that's out there at the moment. That was all I wanted to say on corporate tax and gift aid, so I will be moving on now to Glyn, I think.
Brilliant, thank you, Paul. Great to hear you again. We've got an awful lot to run through on the VAT side. There's an awful lot of bits and pieces there, and a wide variety of topics. I hope that at least some of this will be of interest to you. Yeah, let's start with the first one, which is talking about the temporary reduced rate for hospitality. So this is a VAT stimulus package that was announced by the government and designed to help out the hospitality and tourism sector prominently. Now, of course, many of the organisations on this call do operate within those sectors and have cafes and attractions and even holiday accommodation. So let's have a quick dive into that. So the 5% VAT rate is a temporary rate. It will apply between the 15th of July, a couple of weeks ago, right the way through to the 12th of January 2021. And this applies to the supplies of food and non-alcoholic drinks only, unfortunately, from restaurants, bars, cafes, and similar. And it also applies to the supply of accommodation and admission to attractions. So if you look at the admission to attractions first, the reduced rate has a list in the legislation of things that will that will be covered, from shows, theatres, circuses, etc. I won't read them all because it will just bore everybody to death. But the revenue have helpfully also confirmed through the Charity Taxes Group that missing from that list but still included includes historic houses, other buildings and places of historic interest. For example, and these are only examples, windmills, lighthouses, forts, towers, gardens, parks, sites of natural beauty, etc. But I think the positive for me that there is, although the law does contain quite a restrictive list, the revenue are looking at this more widely, and actually if you don't fall directly into it but you are opening an attraction, then it's well worth having a think about that. It also applies to the value of admission when you're calculating membership apportionments, so that's worth looking at. And finally, I would also say if you're having a charitable fundraising event, it's well worth having a bit of a think about whether the 5% rate will be better than taking the exemption. Obviously, with the 5% rate, you have the right to recover VAT on associated costs, whereas the exemption you don't. So well worth looking at that one. So the guidance is out. It's very, very helpful, but it doesn't cover everything. There's a couple of items that I just want to quickly mention to you, which are worth interacting with. The first one is the tax points. Whenever there is a drop in VAT rate, there is a standard bit of VAT law which basically says you have the choice to use a basic tax rate, tax point, or the actual tax point. Now, normally, if you receive payment or you raise an invoice, that's a date in which you have to account for the VAT, even though performance could be at a different time. With these special rules, because there is a drop in tax rates, and even if you have received payment or invoice beforehand, you can still apply the lower rate, providing the performance of that activity is during the lower rate. So if you receive a prepayment for a supply that's going to take place post 15th of July, you can use the lower rate. There's a little bit of confusion as to what cafes and similar premises actually mean. I know a couple of my clients have been looking at that and saying, well, actually, it's not actually a cafe and it's not actually a pub, but does it actually apply to that? And there's a very strange comment in the public notice that says that the 5% does not apply to off-premises catering. We're not entirely sure what that means. I assume that it means delivery of food to individuals, but I don't know. Is the answer, because I would have thought that would be covered under the takeaway rules, but strange. It's also worth noting the interaction with the tour operators margin scheme. Obviously, in that case, the margin is going to be slightly higher, and therefore the VAT at 20% is going to be higher. Very, very last thing, the help out to eat out scheme, or eat out to help out scheme rather, VAT will be applied to the full amount that will be received by the retailer. So if you offer a 50% discount, you will have to account for VAT on 100% because you're going to get the extra 50% back from the government. I think that's just about it on that one. All I'd say on the temporary reduced rates, therefore, is think about your systems, your e-POS systems, your online booking engines, your back office stuff, and make sure you've got the correct rate of VAT being showed. Make sure when you raise sales invoices, particularly, because I know a lot of the time you don't raise sales invoices and you get asked on a one-off. Make sure that you're ready to do that at the lower rate, not the higher rate. I think there is a fundamental strategic decision to be made by Charities here, and that is whether pass on the VAT rate change and stimulate interest in what you're doing, or whether you hold the price and actually treat it as additional income. That is best made as a fundamental strategic decision by the organisation rather than a default. And I would encourage you to have a think about what that means and how you're going to do that. Also, how you're going to communicate that if somebody asks a question. So on that note, I would also mention that about supplies being made beforehand. So you raised an invoice before the 15th of July and then something happened afterwards. I would have a little bit of a think about training your staff just to make sure that they're able to handle queries on that. So a couple of things on forthcoming changes. The first is the domestic reverse charge. This has been pushed back until March 2021. Now, for most of us on the call, we're going to be end users, so we're not going to have to actually interact with it. But there's now a formal requirement to issue an end user certificate to your supplier. So if you're having construction work done that falls within the construction reverse charge, you have to tell the supplier that you are the end user, and they will then charge you VAT in the normal way. Now that's quite important. The other thing that I'd mention, if this does come live in March 2021, this is going to be exactly the same period that all these guys are also going to have a double VAT payment, and also the government loans start to be paid back in March 2021 as well. So given that most construction firms rely very heavily on the VAT for cash flow, there are going to be some real problems in March 2021. You may want to think about due diligence of your suppliers. You may want to enter into a dialogue and see whether you can help them out. The last thing you need is half-done construction job and your supplier going bust. A very, very quick mention on making digital. The second phase has now been postponed for all taxpayers with complex and simple until the 1st of April 2021. And you can still ask the revenue for permission to delay. Not a problem at all there. But what I would say is use that time. Making tax digital is difficult. It is complex for charities, particularly because of the partial exemption position, and everybody is struggling with it. We've been gifted another few months. I would use that time. I would use that time carefully. So we would also mention the VAT zero rate on electronic publications. Now this came in from the 1st of May, so it's not massively new, but it's worth, I think, revisiting it very, very briefly. It's a really welcome change. It removes a rather silly anomaly between paper and electronic supplies. Which is really, really welcome. There's still some confusion of the exact scope of it, though. By which I mean, you know, there's many things that are electronic publication, but they're searchable, they're involved in databases, and they have other functionality. We're still not entirely sure where that dividing line is going to fall. But it's important to interact with that. So if you're either buying these services in or you're supplying them yourselves, it's well worth having a look at where that dividing line is. The other thing that I'd mention is that there is a very, very significant impact on membership organisations, and I know that we've got quite a number on the call and in our database. The reality here is that there is a concession available for membership organisations that make exempt supplies, and that enables them to break down their supplies into the constituent elements and tax each element at the correct rate. Now, this was brought about when there were no electronic publications, and it gave some VAT recovery because most members' organisations have a members' handbook and regular periodical magazines. The revenue have been targeting these over the recent months and have been raising very large assessments on the organisation, saying, well, actually, if you're making these available electronically, it's subject to VAT, and therefore your members' benefit is partially taxable at standard rate. This is a major positive change, but if you are a members' organisation and you are using the concession, it's well worth going back and looking at your method, make sure that you've got that right. If you've decided not to use a concession because it's not beneficial, it's worth revisiting that calculation, because in light of this, it might have changed. And I would also say, don't forget News Corp. News Corp is a case, some newspaper basically, that is challenging the zero rate and said it would always have been zero rated historically. They've won in the UK courts, and it's been appealed, and the revenue have invited claims. The key thing here is because you can only go back 4 years from the date of the claim, you've got to do it now, so that you don't lose out money. So moving on to some case law, I want to briefly mention the Royal Opera House case, mainly because it's a bit of an anomaly for me. This is a dispute involving partial exemption. And in order to recover VAT on things, there has to be a direct and immediate link between the thing that you're buying and the taxable supplies that you're making. Royal Opera House claimed that there was a direct and immediate link between the production cost and the cost of putting on the show and their food and drink sales. Because if there were no production, there would be no food and drink sales. It's a reasonable decision to take. Court decision, unfortunately, is that there is no direct and immediate link, and the only link is a but-for argument, which is but for the production, there would be no sales. And that, in recent times, have been kicked out by the courts. Now, I think this decision contrasts very, very sharply in the decision with Mayflower Trust, if you remember, with the production costs and the taxable brochures. Sveda, the European Court decision involving the nature trail and the cafe. Very, very difficult, makes partial exemption that little bit more tricky. What we've got to consider here, think about your partial exemption, think about your attribution within that partial exemption, and think about creating evidence where there is a link between the cost and tax. One of the things that came out very sharply in the case was that there was no obvious link between the production costs and the food and drink sales. If you are going to claim that there is a link, make sure that you document it. It will really help you if you end up in a dispute. So moving on to Welcome Trust, and I'll try and do this quickly, although Welcome Trust case is actually relatively complex from a VAT perspective, but the concepts and the application is actually quite universal. So whenever an organisation that's in business incurs VAT overseas, it is obliged to charge itself VAT as what's known as a reverse charge. Now, it's only business organisations that are required to carry out a reverse charge. Private individuals do not. So the law refers to a taxable person acting as such. And Welcome Trust were told in a previous court decision that their investment activity was very much a non-business activity. And perhaps understandably, they said, well, okay, the overseas costs of managing that shouldn't be subject to reverse charge, because although we do some things which make us a taxable person, this isn't part of that. This is not us acting as such. This is separate. They were originally successful in the UK courts, and the revenue unfortunately appealed, and it's now gone through to the European Court to take a look at. With the European Court, what often happens in complex cases is that the Advocate General reviews the position and analyses what he believes the answer should be, and then the court either confirms that or goes in its own way. Unfortunately here, the Advocate General has looked into quite some detail of the implementing regs and the underlying VAT law in Europe. And although the final judgment is still pending. He's very, very clearly of the view that if you are VAT registered and you are carrying out business activities, if you receive costs from overseas, you should count out a reverse charge. What that means for us is, I think the revenue will have it on their radar. So if you have overseas costs in your organisation and you are VAT registered, make sure you have a look at that and work it out. Obviously, you don't need to do anything now, because we are still in a position where the UK courts have said that the reverse charge doesn't apply where they relate to non-business activity, but it's well worth getting your ducks in a row because the revenue will be visiting it. So very, very finally, before I hand over, and I know that I've probably gone over a couple of minutes, I just wanted to share some general thoughts on COVID-19 and where we are. The first thing really is speed of change. The changes here are at a phenomenally fast rate. We've had 2 new 0 rates, 2 new 5% rates. We've had deferrals and various different deferrals to time limits. And it's going to be very, very difficult to keep on top of that. What my advice there is check multiple sources. To be linked into BDO's COVID pages, for example, and others, just to make sure that you're aware of it, because some of the pace of change is absolutely phenomenal. Cash flow management. In March 2021, there's going to be a major problem for a lot of organisations. Now, many of you will have taken the deferred VAT payments, but that does mean you're going to have a double VAT payment in March 2021. The time to think about that is now. We need to plan for that and see whether we can look down the back of the sofa, as it were, to find out any extra cash that we can free to get that into the system for March 2021. And that includes, have a look at your partial exemption, your business, non-business, have a look at your attribution. Most attribution is disadvantageous to you. You need to look at that and see whether you can attribute to taxable supplies and actually get that recovery. That would be really fantastic. Think about your structure. If you've got VAT and reverse charges, for example, can you structure yourself in a slightly different way? Not necessarily just for VAT planning, but is there a better way of doing things? Finally, if you're going to your landlords saying, look, I need to have a rent variation, or you're the landlord and you're providing people with a rent variation, be wary of situations where there is a barter transaction. So quite often you'll go to your landlord and say, landlord, I need to have a period of time when I'm not paying my rent. The landlord will go, great, yeah, understand that, difficult at the minute. But in return, I want you to give up the break clause, or I want you to do something else. As soon as you've got that quid pro quo, you have a barter transaction, and VAT needs to be considered. So be careful of that. So I think that's an awful lot of VAT. I'm going to step aside now and leave you with Caroline, who's going to talk about managing changes in employment sectors.
Thank you, Glyn. Okay, so there's a few things that I want to talk to you about today that really are important in terms of the way that HMRC are approaching not just the sector but employers generally. So I think the things that are really relevant at the moment is off-payroll working. Although we haven't got that with us quite yet, that's going to be coming in quite soon, and you need to be thinking about preparing for that. I'm going to cover coronavirus support payments, because there are some things that could catch you out, so I think it's worth just giving some hints and tips around that. And then finally, a little bit about HMRC time to pay. So we had an update yesterday from HMRC, so that's really on point, I think. So just on the off-payroll working, it is something that's going to come in for most organisations by on the 6th of April 2021, having been put off from the 6th of April 2020. And I thought it was worth thinking about why HMRC considers that a change is needed in relation to IR35. So, as many of you will probably know, this was introduced in 2000 to address tax avoidance. So it was a Gordon-Brown initiative, and basically it was to try and stop individuals setting up their own personal service companies, withdrawing money from those companies by means of dividends, and avoiding pay-as-you-earn tax. So there's about 1 million PSCs in the UK at the moment. And what was quite interesting is that the new rules came in for the public sector in 2017. And since then, the public sector have said that they've seen about a 3% drop in the number of PSCs where IT consultants are operating them. So that's quite interesting that we are seeing people moving out of the public sector. Are they moving into the private sector, or are they changing their working model? So there was a lack of compliance. Certainly HMRC thought that only about 10% of personal service companies were operating the IR35 rules properly, and we'll explain what those IR35 rules were in a moment. And as it says, the cost of non-compliance in the public sector was considered to be about 700 million. But the estimates now are, if something isn't done about this, by 23-24, we could be looking at 2.3 billion. So there's a huge risk to the exchequer of people not dealing with this properly. And then HMRC just doesn't have the resources to police IR35. So they've got the legislation, but they can't look at every PSC themselves. So what they've done is they've changed the responsibility for thinking about that to the engagers, so to the public sector at the moment, and then to the private sector going forward. Let's just have a look at the current rules then for the private sector. So this is what would apply in charities. So at the moment you have protection from the IR35 rules, so you don't need to think about them as long as. So you need to make sure that the contract is between you and the personal service company. And sometimes what we see is it could be a personal contract. It could be that you say to somebody, "We'd really like you to come and work for us," and that person says, "That's great, but I'd like to do it through my personal service company." The revenue see that paper trail, then they're very likely to consider that actually it's a personal engagement, and the fact that the personal service company is being put in as an intermediary after the invitation to do some work means that the contract doesn't stand up. It has to be a UK PSC. Lots of complications around overseas PSCs, which we just don't have time to go into today. You've got to make sure that the invoice has been issued to you by the PSC, and all payments have got to be made direct into the PSC's UK bank account. Now that sounds pretty straightforward, but again, sometimes what we've seen is that the payments are made directly to the individual's UK bank account. And again, that means that the whole protection, if you like, falls away because you're not meeting the conditions for the current IR35 rules. So there are a couple of issues as well, and I'm just going to pick up on two of those. So directors are office holders and they are always subject to IR35. So even now, before the new rules are extended, if you have an office holder, and for not-for-profit, that could be a trustee. If you've got somebody who you're paying and they're in that sort of role, then the likelihood is that they're an office holder and they should be paid subject to pay-as-you-earn already. So you do need to think about that. And as it says, the pay-as-you-earn and national insurance should be deducted by the end engager. So the person who is closest, if you like, to the personal service company. So there are a number of issues that you really do need to think about if you're using personal service companies at the moment and in the future. So let's just have a look at which engagements the rules apply to. So again, I'll pick up a couple of these. So an individual personally performs or under an obligation to personally perform. So if we just look at that in terms of you're using a personal service company, say you want Caroline Jones to do something for you, so you engage Caroline Jones Limited. What you need to consider is if that corporate wrapper didn't exist, would Caroline Jones be an employee of your organisation? And if the answer is yes, then this is an engagement that you need to think about. And it does say there that, you know, it's where the contract is directly between you and a personal service company, more often than not a personal service company, but that definition is really widely drawn. So a personal service company basically is a company where the individual who is providing you with the service owns or controls 5% more of the share capital. And that means that you might have to ask some really intrusive questions of those individuals, because it could mean that a member of their close family has 5% control over the shares, and that would mean that that organisation would be caught by the new IR35 rules. So make sure that you know as much as you can about the personal service company before you engage them. as it says, if the worker's an office holder, so we covered that off. If that's the case, then you are already caught, but under the new extended rules, that's made much clearer. And then the fee payer must operate pay-as-you-earn and deduct pay-as-you-earn and national insurance. So that makes sense. But if you're using an agency, for example, the decision about whether or not somebody should be treated as an employee rests with you and not with the fee payer. So you must tell the agency if you think that pay-as-you-earn should be operated. So you still have some pretty clear responsibilities under the new rules. So let's just look at what those new rules are. Okay, so these are the new responsibilities. And as I said earlier, these rules have applied, the IR35 rules have applied in the public sector since 2017. But the new rules have been extended. So when they apply to the private sector too, there will be additional responsibilities for the public sector. So one of the major changes is that the end engager, so you, now have to communicate that status determination to the fee payer, so the next entity down the supply chain, and the workers PSC. And that's where there's a difference, because in the past, it was just necessary for you to let the next entity down the supply chain know what your decision was. Now you have to understand that whole supply chain. So if you have engaged with an agency and they've had to go to another agency to get a worker with a skill set that you need to understand the whole supply chain so that you can actually tell the workers PSC as well. The other change is that you have to advise why you've come up with a status determination that you have. So if you've decided that somebody ought to be treated as an employee for the purposes of the off-payroll working, you've got to let them know why. And that's because there's a new disagreement process. So in the past, it might have been possible for you to go to the individual PSC and say, you can get an agreement from HMRC that your engagement with us is one that's outside scope of payroll rules, then you could deal with it in that way. HMRC will not help you now. So the way that it works now is that you have to deal with it. And do you want the original person who made the decision to deal with it, or do you think that there's a need to have somebody else in that chain so that they can make an independent decision based on the facts? As it says, there is a small companies exemption, so does it apply? If you're not a company, then you just have to look at a turnover test. So if your turnover is more than 10.2 million, then it will apply to you. If you are a company, then it's if your turnover is, it's 2 out of 3. So 10.2 million at turnover, 5.1 million balance sheet, or 50 or more employees on average over a year. The other thing that I just want to bring out on this slide is that the revenue are really keen on making sure that you're taking reasonable care. So every step of the way, I would recommend that you document what you're thinking is, why you've reached decisions, etc., because that will have a huge impact on any potential penalties you can pay. And they can be as much as 100%. But by taking reasonable care, you can make that much, much less liability for you. Okay, so one of the tools that HMRC can use is called the Check Employment Status tool, so CEST. It's been updated because when it was originally introduced, it was actually geared up towards the construction industry. So it has been updated to reflect the changes in working patterns, but there's still nothing about mutuality of obligation. And I'll explain what that is in a moment and why that is so important. So as it says here, HMRC will stand by determinations from CEST as long as you've answered the questions accurately and that the practice matches the theory. So what do I mean by that? So contractual terms, that's the first thing HMRC would consider, and then they would look to see whether or not those terms actually match what the contract says. Now, HMRC have said they will stand by determinations, but there's recently been a case with NHS Digital, and they've had a bill for 3.4 million, and they used the CEST tool, but HMRC argued that the information that had been entered wasn't accurate, and as a result, they've got this huge bill. So really important that you make sure that the right questions are answered and that you keep your output. So you can keep the output from the CEST and then you can rely on it. You as an engager must complete this. You can't allow the worker to complete it, otherwise you can't rely on it if HMRC challenge. Take a consistent approach. As I said, there's a dispute process now. This tool, the CESS tool, is applicable for self-employed individuals and PSCs. How do you deal with undetermined? So HMRC says about 85%, in 85% of cases, they come up with a result. What if it doesn't? What if it does say undetermined? So you've got to make sure that what you put into the tool is correct and that you're consistent. So if you have similar engagements, that you consistently answer the questions in the same way. So really, really important to do that. So quickly want to move on to some recent IR35 cases. And this is where mutuality of obligation comes out, really. So there are certain things that the revenue consider when they're deciding whether or not somebody's employed or self-employed. And these are the major ones at the moment. So control, I think, is currently the most significant factor. If you have the right of control over somebody, even if you don't exercise that control, then you still need to think, well, that there's more likely that they're going to be an employee than self-employed. Personal service, so substitution. Can somebody substitute? That's less significant, and HMRC are making it quite difficult for you to actually meet that criteria. And then this mutuality of obligation. So are you obliged to offer an individual work? And if so, are they obliged to accept it? And why that's important is because there've been a number of IR35 cases recently which have hinged on mutuality of obligation. So just to mention one, the Helen Fospero case, where I think it's Canal Street Productions, where there was no mutuality of obligation, even though ITV offered her a certain number of slots a year. The judge didn't consider that was enough to create that mutuality of obligation, and as a result found in her favour rather than HMRC's. And it is a little bit of a lottery with cases at the moment. So we're seeing some cases where we might have expected HMRC to have won and they haven't, and similarly some where we would have expected the PSC to and they haven't. So really important to consider all those points. So just some practical points then. How will you identify your PSCs? It might be quite easy for you, but you will need to look at your purchase ledger. What would be your process? So you need to put a process in place using CEST, making sure that you're consistent. How are you going to make the payment? That's a big question, and it's been a big question in the public sector, because you need to charge pay as you earn, but at the moment we don't charge VAT on earnings unless Glyn tells me something different. So at the moment you need to take out the VAT before you actually charge pay as you earn on the payments you're making. So there's a complication around that. And then the other thing is that this off-payroll worker indicator has been introduced this year. And the reason for that was you shouldn't be responsible for student loan payments or anything like that. But there have been some instances where HMRC have sent notices to engagers telling them that they should be taking student loan repayments, etc. This OPW indicator should stop that. So make sure you use that from April 2021. And then just as it says finally at the bottom, BDO do have a tool that helps you with that identification. It doesn't just look at PSCs, it can look at self-employed people and agencies. So it can try and identify those risk populations for you. Okay, so just summarise those potential risks then. And I put those into 3 buckets. Just to pick up on that, ownership is really important. So where we've seen that work well in higher education, for example, as they've had to deal with that since 2017, is where they have more than one person who has some ownership of this, and perhaps a small team who can think about how they need to put a process in place, what the policy should look like, etc. There are increased costs because now you would be responsible for employers' national insurance and maybe apprenticeship levy if you fall into the apprenticeship levy category. So there is quite a lot to think about in terms of the commercial side of things. And then on the operational side, you know, do you need a worker, or do you need an employee, or do you need somebody who's self-employed? So there's a lot of things to think about in terms of the risks for off-payroll working. So that sort of summarises off-payroll working for you. I know it's a quick run through, but it is one of those things that we're going to see more and more of come April 2021. I know a lot of organisations prepared for April 2020, but you will probably need to revisit anything that you did to make sure that you're ready for that. So let's just move on to Corona support payments then. So very topical at the moment, and just a bit around the new legislation. So as it says there, there's 1 million employers, 9.4 million employees, and 28.7 billion claimed, and that's up by nearly £1 billion since June. So these figures are for July. In June, that figure was 20 billion, and so it's been a massive increase in this month. So HMRC, again, lots and lots of tip-offs. The sorts of tip-offs around where furloughed workers are still working. So obviously this is before flexi furlough was introduced, so they shouldn't be doing any work at all. But there have been a number of cases where HMRC are investigating because of that. And as it says, they're just committed to making sure that they're going to make sure that employees are complying with this. And a bit of news really, yesterday we heard from HMRC that they're just very interested in those that have fraudulently claimed and less concerned about those who have accidentally overclaimed. So we'll talk about that a little bit later. And there is some new draft legislation. I think we had Royal Assent last week. So as you can see, you know, there's quite a bit of money coming out at the moment. And as a result, HMRC are really committed to making sure that this is dealt with properly. So just to look at the summer statement then. So as it says here, there's no change to the phasing out. So it will be fully phased out by the end of October. But the funding has changed, is changing from August. A couple of other things that were announced, the job retention bonus. So that's really quite useful, and some payments for apprentices. So they are trying to help keep businesses going and to encourage businesses to keep their employees on as well. So next slide is just about, it's just a table to show you how it's working in terms of the flexi furlough, what the changes are going to be. So just a couple of tips on this slide. Because the way in which you calculate the Corona job retention scheme payments changes, it would be recommended that you put people into 3 different buckets. So when you're doing your calculations, look at those people who continue to be fully furloughed. Then you need to look at the fixed hours, people who are flexi furloughed, and the variable hours, because the calculations are very different. So HMRC's got quite a lot of guidance on their website, but it is quite a complicated process. So by putting the people into those 3 groups, it should make it a little bit easier for you to deal with them on an individual basis. So what might go wrong? There's a lot of things that can go wrong in this. So maybe you're claiming, but you're not meeting the right criteria. So you must keep that paperwork. You've got to notify staff if they're being furloughed. And of course, there is now this flexi furlough. So if you've had somebody who's been fully furloughed but are coming back to work part-time, you need to be notifying them in writing and keeping those records. So just make sure that you are doing that. The other thing that I'd like to pick up on here is the salary sacrifice. So if you are making payments under the job retention scheme, it's based on post-sacrifice pay. So unlike a lot of other things that might be based on pre-sacrifice, it's post-sacrifice. So make sure that you're doing that. And then I think it's worth picking up on that last point. So some arrests were made at the beginning of July. I think the biggest was for a potential fraud of £495,000. And I think in that particular case, it was because staff were still working. So as it says at the bottom, it's essential that you're able to back up your claim. So make sure you've got the right paperwork in place. Make sure you keep it. Make sure your online submissions are correct, and do pick up that point about salary sacrifice. So how do you correct overpayments then? So you've accidentally claimed too much. What can you do? So if you discover that you've made an overclaim within 72 hours, you can delete that claim and start again. So reasonably straightforward. If you've discovered it after 72 hours, then you can adjust it in any current claim to rectify the position. So again, quite straightforward. Or alternatively, if you can't do that, then you can make a lump sum payment to HMRC. And we weren't sure of the mechanism about that until yesterday. And basically what you can do is you can phone the helpline and let them know that you want to make a lump sum payment, and they can help you with that. Some employers have been paying back amounts claimed under the job retention scheme voluntarily because they feel they haven't needed them, and HMRC are, as you would expect, very keen to receive those payments. So it is possible to put things right. So the last thing I just wanted to talk about is time to pay, and give you a bit of an update on this. So what should you expect if you need time to pay? So as it says, HMRC was very accommodating. So I'm talking mainly about pay-as-you-earn, although you will see there's some reference to VAT and corporation tax on the slide. But from a pay-as-you-earn perspective, what was happening was that the revenue was saying that they would be happy to postpone payment until the 30th of June. But they have started now to revisit that, and it's much more difficult to get that payment plan. And so basically you do have to provide quite a lot of information. And as it says, you need evidence of your financial position. You've got to explain what's happened. You've got to make realistic proposals, and you've got to look at the financial support from others first. So really important that you make sure that you give HMRC all the information that you need. And the final point that I want to make on this slide is that if you've been making claims under the job retention scheme and you've asked HMRC if you can defer your pay-as-you-earn, they are now saying that if any of the deferred pay-as-you-earn is actually in relation to payments made under the job retention scheme, they expect you to pay that immediately, because effectively they've given you the employer's national insurance and they've given you the payment so that you can deduct tax from national insurance from the individual. And in some cases, they have said that they will not allow you to claim under the job retention scheme if you haven't made those pay-as-you-earn payments. So just be aware of that. It is possible to negotiate time to pay, but there is a little bit of an issue around that. Okay, so I think that's everything I wanted to say on employment tax. If I can hand back to Jill for some questions, please.
Thank you so much. Thanks to you all. Lots and lots to think about, and not just tax. I mean, what I took from that is that there's also some governance, as well as some legal aspects as well to think about as we're thinking and trying to manage all of the complexities that COVID has brought on us. I think it's definitely going to be a more complicated year this year and the following year. So I am conscious of time. We've overrun very slightly, but we do have some good questions coming through. So I did want to spend another 10 minutes or so, if people can, just answering those questions. So maybe if I start with one for Caroline. We've obviously seen with off-payroll rules, the introduction came in, as you mentioned, to the public sector earlier. And do we see HMRC being active in reviewing compliance with the new rules for the charity sector as they have been in the public sector?
Yeah, so I think it's fair to say that probably for the first year in the public sector, there was a bit of a soft approach. So HMRC were doing a bit more around education, going out and actually reviewing what the public sector were doing, but perhaps giving them a bit more guidance rather than actually charging them penalties. But at the end of the first year, we definitely saw a firming up of their stance. So I suspect there may be a little bit of leeway, but as HMRC themselves have become more familiar with the off-payroll rules, I think that they might be a bit stricter than they were with the public sector initially. So I would say for the first 6 months, possibly a bit more education, but after that, you can expect to see them visiting and charging penalties if they think something is wrong.
Okay. That's really helpful. Hopefully that answers Bernard's question as well. That's just come through on a similar topic. And for Paul, can I ask you mentioned, Paul, around taking out the management charge where you have a parent charity supporting a trading subsidiary. But what's the revenue stance on reducing that management charge? So I was just thinking, we've got quite a few clients who have been caught up with this question actually, where they're renting from the parent charity but haven't needed the building, for example, during lockdown. Is the flexibility around reducing the management charge between the two entities?
Yes, so there's two areas there. One is the rent itself. So from the charity's perspective, rental income is an exempt income source for corporation tax. So the level of rent is a question really only of whether you are getting your fair rent from your subsidiary. So what if you were taking out office space to allow a subsidiary to use it and weren't charging for it, the cost of doing that would be non-charitable expenditure, which would create a tax issue. The question is it the right amount of space, and are you charging the right amount of rent for it? So obviously if everybody's gone to working at home and that office space is no longer required, then there's a pretty good argument to say that the subsidiary should be paying less for it than it would have done when it was occupying a greater share of it, and that would be fairly common. Associated to that is the services that a charity would often provide a subsidiary. So you'd have back office support work being charged by the charity to the subsidiary. Now the standard approach to that is to cost share. So the subsidiary will be taking a share of its fair share of the cost related to running that organisation. And that cost sharing agreement that should normally be in place should be flexible to accommodate movements in the demand from the subsidiary. So your cost share amount will go up and down according to what the subsidiary requires. So yes, the short answer is yes. You definitely could, in theory, move those costs up and down according to the needs of the subsidiary to use them. But of course, you should get into your actual agreements and make sure you're not defaulting on what you've agreed in the past.
Great, thanks, Paul. That's really helpful. I've got a couple of questions for Glyn. One of our participants has stopped accounting for VAT on reverse charges following the case that you mentioned. What do they do now?
Short answer is nothing yet. If you are currently the UK jurisprudence is that Welcome Trust was quite correct. It incurred costs in connection with a non-business activity, and therefore it did not have to do a reverse charge. The Advocate General is just an Advocate General, but it's worth noting and starting to prepare to make that payment back, because the court goes with the Advocate General in 90% of cases. So nothing yet, but get prepared, because it's likely. Looking at, sometimes when you read an Advocate General's opinion, you look at it and think, I'm not sure about that. This one, I think the court will go with it.
And on the other case that you mentioned, News Corp, how likely do you think they will win, and when do you think there will be a decision on that? Is it worth lodging a refund claim now?
Yeah, it's a very good question. To take those three elements, do I think they're going to win? Honestly, probably not, but I didn't think they were going to win in the first case. So betting on the courts is a great way of losing money. I think it's unlikely, but there is a decent possibility that they will win. I don't think they will, but there's a decent possibility for that one. Is it worth putting in a claim now? Yes, definitely. The problem being is that you can only go back 4 years from the date of the claim. So it's entirely possible that News Corp will go through 2-3 appeals yet. Might end up in the Supreme Court even. It's such a big case for News Corp. It means an awful lot of money, and it's very well funded, the appeal. That means that if we end up 4 or 5 years down the line and they win and we put a claim in, we will have lost 4 years worth of claims. So yeah, do it now. And if you're an exempt charity who is incurring costs from a provider, make sure the provider has made the claim as well.
Thanks, Glyn. That's great. I don't think we've got any other questions coming through. So only taking an extra 5 minutes of your time. So it just leaves me to conclude, really, just to say a huge thank you for everyone for joining. Any feedback or any suggestions that you have on future webinars, we'd be very grateful for, just so we can tailor the content to what you would like. A huge thanks to our 3 wonderful speakers, and a big thanks to Hannah as well, who's behind the scenes making all of the technology work for us. And if you do have any charity tax issues or any questions, there's a lot to think about, as we've just articulated over the last hour. Please do get in touch with us and we can help you through that. Thank you so much and have a good day.